Hey everybody, welcome back. It's Thursday. That means it's the Financial Thing Thursday live stream. Doesn't a week go by so fast? I mean, it's crazy. I feel like I just did this, just wrapped it up, and now we're here again. Um, it is here in Orlando, 27 degrees Celsius, and we're having a really nasty storm right now. A minute ago, outside it looked like there was a hurricane. You just couldn't see 5 inches in front of your face. So if the power goes out and we lose the stream, apologies in advance. Can't do anything about that. If that happens, I'll just record the video and you'll have to catch up on it. But hopefully that won't happen. Fingers crossed. Yeah, it's crazy outside right now. You can see how dark it is in here. Even the dog is a little bit concerned, but not very much. She seems to be doing well. But anyway, thanks for joining. Today we are going to be talking some peer-to-peer lending stuff about Cufflink, about Mintos, about LendInvest, about London Property Exchange, aka Property Partner. We're going to talk about inflation, a report that came out, the Bitcoin price, and I just wanted to also say that I got a couple of emails this week, actually over the last couple of weeks, been asking me about advice and what to do with the investing. And I just want to say that you should never ever listen to anybody giving you advice, especially somebody on YouTube or Twitter. I think it goes without saying, but I also think I need to mention it because there are a lot of people that do take their investment advice from people online, and just make sure that obviously you do your own due diligence because none of us really know that much at the end of the day. I just speak about my experiences. I get things wrong all the time, as you'll see from the Trading 212 portfolio. So I think it goes without saying, but please do your own research, do your due diligence. This is for entertainment purposes only. I'm here just to entertain you for an hour, tell you about the things that I'm doing and the things that I find online and the information. But there's a lot of people out there that are a lot smarter and a lot more intelligent than I am. You know, like I say, I make mistakes. So please do your own research. But this stream, by the way, of course, is sponsored by our good friends over at Cufflink. Down there, just a little bit. That would be east of London. Earn up to 9.83%. It's actually more right now. We're going to talk about that today in the stream. But they've got now, I think, over £327 million of UK property-backed investments made since 2016. Zero investor losses to date, they claim. Capital is at risk. Don't invest unless you're prepared to lose money. Remember, this interest rate can change as interest rates do fluctuate. And you can sign up at join.cufflink.com/financial-thing. The link is in the description below. But check out Cufflink, very generous sponsors of the stream. We are going to talk about them. Actually, they are going to be our first little story today. But a quick hello. If you could hit that thumbs up, please do so. That would be really helpful. And a little bit of housekeeping. I do believe at the end of this month on maybe the 30th. Let me check the calendar here. No, maybe or April, right? 25th. Right now we have Mike Bristow from Crowd Property scheduled to be here. Hopefully that happens. And then on May 9th, we got Natalie Weeks from Cufflink, who's going to be here talking about collections and what they do to go after these loans that are running behind. So that's going to be interesting. Put that on your calendar. May 9th. Natalie Weeks. She's been on the stream before. She came with Harry. It's been 2 or 3 years since she was here, but we're going to have her back on the stream again. So a couple of guests lined up for the next 4 weeks. Hopefully more in the future. So put it on your calendar. Okay, a quick hello to everybody. Evening from Darren in Cambridgeshire, of course. Dave Dawson from Staffordshire is here. Colin Perry in the Peak District. Alan Stratford in Worcestershire, home of the Worcestershire sauce. Mike Powell, usually down at the pub or in Southampton somewhere roaming around. John Day in the Nottingham. Peter Vince, of course, in Leatherhead. And Dave says he's had some sun in Staffordshire today. You know, we have had absolutely zero sun today, which is weird. Yes, I know that front sheet is a little bit out of date. Thank you for pointing that out. I'm trying to get an updated one. It has to go through compliance for Cufflink, so they will be sending a new one soon. Paul Bagworth from Kenilworth, Aggie Chap with the Bitcoin emoji. Also here from Accrington, of course. Now it's raining over there. It seems to have stopped raining here for now, so that is a good sign. I was going to move the camera and show you how crazy it was out there, but right now it's not doing anything, so it would have been a bit of a letdown. Anyway, let's get right into the news. Here we go. We had an email within the last couple of days from Cufflink. It's a newsflash, a Cufflink newsflash, saying, with the closure of one tax year comes the fresh start for the next. Of course, we just had the tax year pass on April 5th to April 6th, and now we're in the new tax year. Now you have a fresh £20,000 tax-free allowance, your ISA allocation, which you can put into the Innovative Finance ISA, the IFISA. And to celebrate, Cufflink has brought back its 1 year auto invest term with a very appealing rate of 10.25%. Come on, Cufflink, get centered. 10.25% you can get for 1 year. That is a very, very good 1 year rate. I mean, as rates go. Because if you look at it compared to the 2 year, they're offering 8.5% with a gross annual interest rate equivalent of 8.86. 3 year, 7% with a gross annual interest equivalent rate of 7.5%, right? We're also pleased to announce that as of today, you'll be informed of all expiring auto lend IFISA investments 60 days in advance rather than 180 days. This adjustment has been made to ensure you have the opportunity to review and reschedule terms, payments on expiring investments based on the latest interest rates. We are confident that this will enable you to make better informed choices regarding your finances. That's a pretty good lead time, giving you 60 days. So if we go into Cufflink's dashboard here, you click on the auto invest at the top, you can see now this 1 year rate has been added. That one of the things you need to know, by the way, it's £500 minimum investment to go into the auto invest product, and you will receive payment on maturity after 1 year. You will not get any payments within that year. So if you do need to get some payments, you're not going to be able to do that with the 1 year product. You can see the 2 and 3 year rates. I got to tell you that 10.25% promotion rate, whatever it is that they're doing, is very, very high for a 1 year product. They obviously want to bring some money onto the platform. I don't see any sense really in taking a 2 year rate or a 3 year rate. I think this is basically going to maybe kill these two products here, because why would anybody take a 2 year rate at 8.86 or a 3 year rate at 7.5%, especially when it's looking like the interest rate's not really going to get cut like everybody thought they would. And we'll talk about that a little bit later. But that, I would certainly, if it was me investing my own money, would certainly consider that 1 year 10.25%, at least for a portion of my portfolio, because that is a very, very good rate. Let's move on. I got this email from Mintos saying we've raised €1 million in less than an hour. So basically, Mintos has gone on to Crowdcube to raise money, and they basically offer shares in Mintos. So you're getting equity shares. I believe it's 2.5%. They've raised €2.6 million. I used to have a Mintos account until they closed it down to UK investors. They offered pretty good rates, but I did have some defaults. I think I had about Out of my entire portfolio, about 25% of it defaulted in the end, which didn't actually mean that the returns weren't actually that good when you factored that in, even though they looked really good. But I've been in there for a few years, so it still did okay, but it wasn't knocking it out of the park. But anyway, seems like 2,559 investors have dumped 2.6 million euros of investment for the business of Mintos. Now, this is not their loans. This is you're investing again in the equity through Crowdcube. You get 2.13% of equity for that 1 million. It means they're putting a pretty huge valuation on the company of 120 million euros. They say they've had a very good net profit year of 727,000 in 2003. And I always am interested by these Crowdcube offerings. They do them, of course, in seeders too. People love to buy these shares. Some of them you can use as tax beneficial shares, but not this one because they're based in Latvia. Some of the UK ones, I think it's EIS, you can use for things like gifting. If you want to gift money out of your estate, you could buy these shares, but not these ones. But I always like to read some of the comments, right? In the discussion, because I'm interested just how people can really justify putting money into these types of shares, because I always think they're really super risky. So this was an interesting comment. I thought if you do invest in these types of things, you might want to pay attention to this. But I'm a long-time Mintos investor and really appreciate what the company has built. However, I don't see how this crowd investment could be attractive to anyone. Even if the financial forecast, which I find borderline optimistic, materializes as presented, I seriously doubt that any crowd investor will be happy with the outcome. This projected net profit of around 600,000 euros in 2026 would mean that it would take 187.5 years to refinance a company valued at 120 million euros without discounting future earnings. And this is a really good point down here. However, as a business is worth what people will pay for it, as of now, there seems to be enough crowd investors out there with more than a vivid imagination about Mintos's future. So if you do invest in these types of things like through Crowdcube and seeders, even if it's in a peer-to-peer lending business, which it's very common for peer-to-peer lending companies to put their equity onto places like seeders and Crowdcube because they're trying to raise money from the crowd to invest in their business. Sometimes that's because they don't have enough money to do the things that they want. Other times, I'm not exactly sure why some of these companies do raise these types of money, especially because they're usually venture capital backed by venture capital companies. Sometimes they just need some extra money, but it's pretty common. But I personally am not smart enough, and I'm not an accountant to really go through these numbers and figure out if this is an accurate valuation for this company. Question is, are you going to get your money back? That's what you need to figure out when you're buying these types of shares. So this one is going to be valued at 9 euros a share, a little bit over 9 euros a share. And I don't know. I mean, these share prices tend to fluctuate. You can see share price here, 9.85 euros. So what happens if people buy them and then they try to sell them on the open market, and some people trade them? Like I said, it's pretty risky stuff. So just be prepared to just do your due diligence on these types of things, because they can go to zero, especially if the company fails. You will lose all your money. Sometimes they tend not to do well. I have seen share prices that have doubled, but I put it akin to gambling because these shares are really based on sentiment. If people are happy with their investment, they tend to hold on to them and buy more. If they're not happy with this business or their investment, they sell, and then the price drops. We saw that actually on the property partner share market. That's exactly what happened. I'll show you about that too. This is a report about lenders increasing in default rates borrowers or lenders are reporting an increase in borrower default rates in Q1 of 2024. Both defaults on both secured and unsecured loans to households and loans to both small and medium-sized businesses have increased in the first quarter of the year. Maybe that's why Assets Capital is having issues, because they've lent to so many SMEs, small and medium-sized businesses. If you look at your portfolio on Assets Capital, you're going to see you have quite a lot of defaults in that. I'm not really surprised about this. I mean, with interest rates as high as they are, companies that are borrowing money are struggling to pay those loans back, and they're experiencing, some of them, strangulations in cash flow and profits, just leading to default rates. That can also happen in the development business as costs of goods go up and interest rates on loans are high. I mean, you can take a Cufflink for an example. If they're offering lenders a 1-year rate of 10.25%, how much are they charging to these borrowers in order to pay you 10.25% and for them to make a profit? Well, guess what? Those borrowers have to pay those loan payments back, and they can get expensive. I wanted to show you my LendInvest account because there are some interesting statistics in here, and I always consider LendInvest to be a pretty solid, and I hate to use the word safe, but steady, kind of a middle of the road company. Does what it says on the tin, not strictly peer-to-peer, but still a company that goes along the lines of a peer-to-peer investment. But again, they're not lending directly from the peer-to-peer lender to the borrower. It goes through LendInvest themselves, so you're really lending to LendInvest. But what was interesting here is look at these numbers here. We got 19 of my loans are on schedule, 4 in arrears, 2 out of term, in breach, and 2 in enforcement. So that statistics means that out of 27, I believe if my math is correct, there is 8 loans that are in the red zone, I call them. Obviously, enforcement is much worse than in arrears. But that's about 22%. So a little on the high side, I would say. And I definitely gets my alarm bells ringing when I see, I don't want to see numbers in the 22% that are in the red. I want to see a lot in the green and just maybe 1 or 2 here in these red zones. So that would kind of go along maybe with this report about how certain default rates are rising, because we've seen it within some of the peer-to-peer lending accounts. So keep an eye on these numbers. They're really important. I think it's if you start to see these numbers getting higher and higher, then it's a time to look at maybe exiting some of your investments out of these here in LendInvest possibly. Don't say I didn't warn you. And I noticed a couple of these, let me log back in here, but I noticed one of these loans that was enforced, actually in enforcement, I believe, or in arrears, was quite a high amount. LendInvest just tend to really lend some pretty large loans. Let's see if I can find the one. I don't know which one is it. Let's see if it's this one. 1 second. No, it's not the one I was looking for. It's this one. There's one that was several million. Yeah, look at this one right here. This is one that's in default right now. Total loan amount, £7.9 million. So that was one of the things I wrote in my original review about LendInvest that I thought was a little bit scary about them. They do some really big loans, but they do have, I think, a couple of billion under management. So maybe to them, 7 million isn't a big loan. But the problem is when one of these decides to go belly up, it's a pretty decent, substantial size loan. So total securities, 12.738 million as valued. I don't know if that valuation is accurate or not. But yeah, keep an eye on those default rates through any peer-to-peer lending company. You need to watch what's going on. Also had multiple emails this last month about ISAs and the changes to ISAs this year, how it affects peer-to-peer lending. So I wanted to just talk about it again because some people seem to really not understand what these changes are. They are actually really good changes. So the main thing that you are going to want to know is if you are using an innovative finance ISA, which you got the cash ISAs, the equity ISAs, which are stocks and share ISAs, and then the ISA, which is crowdfunding ISAs and peer-to-peer lending. So you could put CrowdCube, any crowdfunding investments inside those ISAs. But from April 2024, you can now open multiple ISAs of the same type in the same tax year. You can invest your whole ISA allowance into a IFISA if you want to. The ISA allowance is £20,000, so it has not changed for the 2024 and 2025 tax year. We'll see if that goes up for 25-26. Alternatively, you can split your ISA allowance between different types of ISAs as long as the total combinations of contributions in a tax year do not exceed £20,000. So basically, if you want to have a cash ISA, stocks and shares ISA, and an IFISA, say peer-to-peer lending, for example, ISA, you could do that. You could put, $4 or $5 in each and split them up. And then on top of that, if you want even more ISAs within, say, peer-to-peer lending, you want 5 different peer-to-peer lending ISAs and put 1,000 in each. You could totally do that. So you just have the flexibility now to pretty much do whatever you want, which is really great because before we were really locked in to just having one ISA in each category and not being able to open more than one. You could move old money in from previous tax years into new ISAs and split those up, but for the newest year you weren't able to do that. I never really understood why. It didn't make any sense. So thank God somebody within the finance government department decided to change that, or the FCA. I don't know who it was, but thank God for that. Now you have complete flexibility. You got to keep good records, because if you put too much in, you're going to have a problem with Mr. HMRC in the future. I've done it myself in the past. I put too much in by accident, and that's not a good thing. You don't want to have to do that. So make sure you keep records. Just put it on a spreadsheet, write it down in a notebook, and keep your allowances tracked so you know how much has gone into what for the year. And you'll be all right. Then you won't be annoying Mr. HMRC. Now, moving on. I'm going to show you my... Hang on one second. I got to remember my login. Here we go. I'm going to show you my London House Exchange account, because some of the portfolios are very interesting. Now, case of transparency here, I do not have a big balance in London House Exchange because I sold quite a lot of stuff off quite a while ago, and I was a little concerned about the company. But I don't know if you're going to be able to see this. It's kind of small. As you can see, every one of these loans in my portfolio that has a little flag next to it, basically after 5 years, all of these properties go up for a vote. And the owners can decide whether they want to hold on to them or whether they want to sell them. So you could see here at the top it said this property has been voted for sale by shareholders as its 5-year anniversary. So if you click through each of these properties, you can see it's been voted for sale. And I think, if I had to take a guess, that single one of these properties will be voted to be sold off, because the owners of these shares, us as owners, have not received dividends in a really long time, as we were led to believe that we would be. And also some of these share valuations, so you basically are buying shares in these properties, but a lot of these share valuations have done really poorly. So you can see, well, you probably can't see, but here, so if I can zoom in, I'll show you one of them down here, which is down 41% total returns. We have a lot of negatives here. There's a couple that have been okay, but you can see minus 80% on this one. Check this out. Share valuation 29.68. We paid 203.55 originally for these properties in the West Yorkshire and Huddersfield. So this has just lost a ton of value on the share resale market. We'll see what happens when eventually it comes up for sale and it gets sold. But people who are exiting out of these shares at a loss for probably tax reasons are really taking big hits. This is probably, it's not been a really good investment on the peer-to-peer side. Some of it was okay, but this is one of the downsides of diversification. If you do choose too many things, you are going to get stung because you're going to pick some that are really bad. But the problem is, if you don't do it that way and you just pick and choose, hope to get it right, sometimes you get it wrong anyways. But you can see here, this is the volume traded, 16,000 pounds. So this is really not high volume for the 1 year. That's just not much going on at all. You can see here the total volume over the max amount of years, which that'd be over 3 years, has been 200,000 pounds. So there is some trading going on if you do need to exit, but nothing in the last 30 days on this particular property, and only a little bit in the last 3 months. So there's not much liquidity going on here. People that want to exit usually are either going to take a really big discount or they just have to wait for these properties to be sold. But you can see every single one of them is under a resale flag vote, which doesn't really bode well for the future of London House Exchange, because once they liquidate all these properties down and out, if they can sell them, I'm wondering what happens to the business at that point, because they're not offering new products, and they haven't for a really long time. So I don't know what happens to the business. Common sense might say that the business will no longer exist because there is nothing happening within the business. Makes me a little concerned. Where is the operating income coming from? I don't know if they're coming from management fees or other types of fees that they have going on that I don't know about. But when there's no products being offered, that means the company's basically just not doing anything, and that's a little bit of a scary place to be. But I wanted to show you that. So if you are a London House Exchange investor, you're probably feeling some of that pain too. And if you were considering it, just know that I would say you might want to pay close attention, make about your decision with that one. I'm not saying it's right or wrong, because I don't want to give the wrong advice, but you can see from my account, it's not always looking particularly great. In fact, you can see here total return. This would be over year. We're talking about 5 years, 11.3%, right? It's not great. So you're talking about a couple of percent a year returns. I've had this for really quite a long time. Actually, maybe even longer than that. So I'd be lucky. Actually, I think it's maybe a break-even one at best. Have had a little bit of a dividend out of it, but not a really good one there. Assets Exchange meets another major milestone. They've paid out £3 million to investors, so good for them. Assets Exchange is not a big peer-to-peer lending company. They're very small, and I think this is a really good milestone for them. They have paid out £3 million, over $3 million of total interest to investors. Now, monthly interest payments are £100,000 or more a month, and this keeps growing as regular rent reviews move rent higher in line with inflation. They have 28 properties which are due to be re-rated this month. One of our main goals is to provide investors with long-term regular inflation-linked income from property while providing much-needed houses to the vulnerable. We are pleased to be meeting this target and have plans to keep adding properties that pay a net yield of 7 to 8% to investors while offering the potential for long-term capital growth given the severe shortage of housing supply in the UK. So if you look at this Assets Exchange potential of 7 to 8% and it's inflation linked, so you could possibly see rents rise to go up. Maybe the returns get a little bit better. And you base it compared to something like London Property Exchange, where you're buying shares in properties where I've gotten maybe 1% returns a year, which is much worse than the bank. We'll see what happens with the sales of these properties, but Assets Exchange doesn't look like a bad place to diversify. So congrats to them. Blend sends out a property pulse report. There's usually some interesting statistic in here. I thought this was really very interesting here. Minus 18%. According to the National Housing Buildings Council, the number of new homes completed in the UK last year fell by 12% compared to 2022. I don't know if this is which one is a typo, if it's this 18%. I guess then compared to 2022, it's probably minus 6%. And now we have minus 18% less homes, which means good for the peer-to-peer lending business, getting more applications, more building projects. Hopefully going to go up because the number of new homes being completed seems to be less. But on a good note, Northern Ireland is up 4.6%, which is a place that Blend has tried to target in the past for potential opportunities. Got this email from Funding Secure Limited about their administration. This was a really interesting one. This has been going on for quite a while now. Basically, to summarize you and not to bore you, but there is a loan that had a first loan and a second loan, so I presume two tranches of a loan that went into default. And out of the total loan, which is $462,000 and $1.4 million, so that is almost close to £1.9 million, the properties were sold together and the net proceeds were $871,483, so about 50% of how much lending went out. Now, the interesting thing was they decided to give the second loan people priority. That was something that they've kind of been going back and forth with the administrator and the legals about. There was people obviously that were in the first loan that was completed on the 10th of April of 2017. That was the number one loan that was secured by a second charge on a substantial property with adjoining land. And then they added the second loan, of course, and then when this went into default, the people who were on the first loan were prioritized behind the people who were invested on the second loan. So there was obviously a big brouhaha about that. A lot of people were upset. They went back to the administrator with legals and said, the administrator said, okay, we're going to look at this and maybe we'll rethink it and maybe we'll just do it evenly and give everybody first and second loan exactly even priority. Then they came back again after further instructions from the lawyers and said no. There was nothing when I think there was a new loan that was written, and there was nothing to show which priority was to be given. So they decided to go ahead and, for some reason, reverse that. I'm sure I'm butchering the way this is because I just got this email literally half an hour before I went live, but they've gone back on their decision and said that people who on the second loan would have priority over investors. You can see it right here. Second loan have priority over investors in the first loan over the proceeds. If you have a problem with this, you can contact the administrator. Look at this. Any investor who wishes to object should, before the expiry of 28 days from the date of this communication, make an application under paragraph 74 of Schedule B of the Insolvency Act, 1986. And you would have to make that objection straight to the court, it seems like, which is going to be a major headache. Maybe the investors, the Funding Secure Action Group, will take up on the behalf of the people that don't agree with this decision. These things are tricky. It's all to do with the administrators and the lawyers, and this is one of the headaches that come along with any time a loan goes into trouble, foreclosure, and a company goes into administration. Things get really complicated, and it could have just been a case where Funding Secure did not have all their ducks in the row with their paperwork and didn't clearly define prioritization of which loan goes where, who gets priority over the proceeds, which looks like they might not have done on this one. Something simple gets missed, and then it creates problems down the road. Let's talk about inflation. This is important because this is going to affect, this is US inflation, but I believe there will be a knock-on effect to the UK. We'll see April the 17th. I think the UK inflation numbers are going to come out for March of 2024. But in the US yesterday, we got a report of some really red-hot inflation. Consumer prices rose 3.5% from a year ago in March. More that was expected. They were expecting a real cooling of the inflation rate, but no, this thing seems to still be getting out of control. What that means is that the U.S. Fed is likely not going to be able to cut interest rates, as they've been alluding that they want to do that this year. I said back before that I didn't think that was going to happen. I thought if there was an interest rate cut, it was going to be really small. But now with these inflation numbers coming out, I just don't see it. I just don't see it because things on the inflation front are just still not under control. We've got energy rising 1.1% after climbing 2.3% in February, which makes up about 1/3 of the weighting in the U.S. of the CPI, the Inflation Consumer Price Index. And these numbers were higher by 0.4% on the month, and up 5.7% from a year ago. So energy costs up 5.7% from a year ago. Food prices were up 2.2%. Fish, poultry, and eggs 4.6%. Just in egg prices, I mean, it's crazy. So yeah, what I predict here is, and by the way, these inflation numbers are not even the real inflation numbers. These are kind of tempered down inflation numbers. I think the actual numbers are much higher than this. But I think we're going to see this in the UK, and I don't think we're going to see an interest rate cut anytime soon. If we do, it's going to be a very small one. Good for savers in a way, because hopefully your bank interest and, say, peer-to-peer lending interest rates will stay high. But there's a lot of expectation that these inflation numbers are going to come down, and they are not coming down. You can see here there's a news story on the Wall Street Journal saying that hot inflation rates derail case for Fed June, so the U.S. Fed June interest rate cut. So they also don't believe that it will come down. Can look here in the UK that we'll see the next release on the 17th of April, something to really watch out for. I highlight these things because, number one, it affects the stock market, it affects bank interest rates that you get on your savings account, affects peer-to-peer lending rates, really affects everything. This is a very sensitive metric that affects the economy, and especially investments all around us. So important thing to look at. Let's look at the Trading 212 portfolio. We are almost exactly the same as we were last week. 20,492 pounds. We were down close to 20,000. We had a bit of an uptick in the portfolio. I have not really changed much, except added to this creative realities position. You can see the cracks has been bouncing all over the place. If you were trading a stock, this would actually be a good one to trade, but it doesn't have a lot of liquidity, but it moves a lot. So I added to this position. I'm down right now 6.58%, but had a bit of an uptick on the exchange rate, £11.60 to the positive, because of the it's an American stock, so the US dollar and the pound have been fluctuating a little bit. You can see here, to show you, I bought 95 of this stock today, I think at $3.35, because I think it's a pretty good buying price. And then yesterday bought another 71 at $3.54. Prefer to have gotten it at $3.30 something, but that is what it is. So just a little bit added to that position, but aside of that, just Coinbase still continues to perform really well. Now up over 102%. Falco Energy up 60%, and then the draggers here, Green Power down close to 60%. Rivian has had a horrible day today. Look at the stock price now, down 50% over the last 3 months. $9.50. And this is why I say at the beginning of the stream that you should definitely not listen to people on the internet giving you trading advice or which stocks to buy, because this just goes to show you how wrong one can absolutely get it. Alibaba had a bit of a better 3 months, up 4.73%, so up a little bit today. But Coinbase continues to do well, and I can tell you why. Obviously, Coinbase connected to Bitcoin. When we see these things like these inflation numbers rising, people start piling into Bitcoin, right? You see the price now holding around 70,000 US dollars. So Bitcoin continuing to do well because people have very, very high hopes in an alternative way of storing value. For those that argue Bitcoin isn't worth anything, well, it's all about sentiment, and people do believe that due to inflation rates, fiat currency is getting weaker. To have a place where you can store value that is not controlled by any government, Bitcoin seems to be the only real independent place you could do that with nobody really controlling what happens to it. It's not owned by a company. This is very interesting. Just in, we saw a report. BlackRock and Fidelity now hold 396,715 Bitcoins worth $27.27 billion for their spot Bitcoin ETFs. Now, that's just those two companies. Of course, you have ARK, you have VanEck, you have Invesco, you have all these other Bitcoin ETFs that add up and now way over 30 billion US dollars now in these ETFs. It's a lot of money. This is not anything to sneeze at. We're only talking about a couple of months in from January of 2024. Now, the Fidelity Bitcoin ETF holds 10.17 billion. You can see down here in assets. Very low expense ratio, 0% right now, as they're on a promotion until close to the end of the year. And then you got BlackRock's iShares Bitcoin Trust now, which I think has got 12. Now, let me see. Where is the amount? 22.7. No, it's not that much. I don't know how much here we go. 18.5 billion US dollars of Bitcoin held inside this ETF. And unfortunately, people in the UK, because of the government, right, they are not allowed to buy this ETF, but you could still hold the actual Bitcoin if you want. But eventually, I think this is going to change, and I think once regulation gets changed in the UK, you will be able to hold an ETF like this, and it's a really good place to hold in something like an ISA, because if you feel like the value is going to really go up a lot, which personally I do, then having it tax-free is a really, really big benefit. Got through a lot today. I'm a little parched, I'm not going to lie. The rain has stopped. It's just cloudy. Don't forget, May 9th, Natalie Weeks from Cufflink. She deals with collections. She's going to be here live, and hopefully on the 26th, I believe is the date, or 25th or 26th of April. That's a Thursday. We're going to have Mike Bristow from Crowd Property here live. He hasn't been on for quite a long time. So, yes, that is going to do it, I think, today. Let's see if you have any interesting comments. Rich Weber is in Southampton. Hello, Rich. Thank you for coming. Nice to see you. Annabelle in Spain. Hola. ¿Cómo estás? Dave Dawson says, it seems to be a few good offers on Cufflink currently, in my humble opinion. Peter Vince tried to close his Mintos account, writing off defaulting loans, but they wouldn't allow me to do so. Why not? Mm-mm-mm. Uh, I think that is honestly going to. I got to get out of here. I have an appointment in 20 minutes, so I'm going to bid you farewell. Again, hit that thumbs up if you can. Don't forget to visit Cufflink, a sponsor of our show. And I'll be back next Thursday, hopefully all being well. If the good man upstairs wants me to be here, I'll be here. Harley is having a good snooze after that thunderstorm. So as long as she is happy, that I think is the most important thing. And as long as you're happy too. Remember, there's more to life than money. Money is just a tool to be able to do things in life, but ultimately our happiness and health are the most important things, even though it is hard not to focus too much on money. Sometimes it becomes a worry, but focus on your health and focus on loving the people around you. I think that's the most important thing. There's my love today right in front of me. Anyway, that's going to do it. I will see you next week. Take care of yourselves.